The reason you're getting denied credit probably isn't your score. It's because you're applying to the wrong lenders at the wrong time on the wrong bureau. Every lender pulls from a specific credit bureau, and if you don't understand how to control that, you're stacking inquiries, weakening your profile, and killing your approval odds before you even start. In this video, I'm going to break down the top lenders, which bureaus they pull from, the exact data points they're looking for, and how to sequence your application so you can increase approvals and maximize your funding. Make sure you like, subscribe, and turn on the notifications if you want more real strategies like this, not generic stuff. What's going on, guys? It's Coach Keem, and I help entrepreneurs secure 0% funding by optimizing their credit profiles so that it's lender and underwriter ready. Right, so let's get into some top lenders and who they pull from. So disclaimer, you're not going to be using this to randomly apply. You're going to be using this to control your inquiry exposure and sequence your approvals. So first, we got the tier 1 banks. These are pre-approval, soft pull, low-risk entry lenders. So the purpose here is to test your approval odds. We want to avoid unnecessary hard inquiries and warm up the profile. So with American Express, they're typically going to pull Experian. Their minimal score range is around a 670. For stronger approval odds and premium cards, you want to have somewhere between a 680 to a 720 plus. You can slip in mid 600s, but limits will be low and risk flags matter more than your score. Amex is relationship driven, but once you're in, approvals get a lot easier. Now with Capital One, they're going to pull from all three credit bureaus. Their minimum score range is around about a 580 to 620, but for stronger approvals, you want to have around that 640 to 700 plus range, right? Average approvals are seen around about a 600, 650. They're more forgiving than most of the lenders on this list, but they do triple pull, right? They're going to pull Experian, Equifax, and TransUnion, and they're more sensitive to things like inquiries and recent accounts. Higher limits usually require a cleaner, more established profile with them. Next, we got Discover. They're going to pull from Experian. Their typical score range is at minimal, it's around 620 to 650. For stronger approval odds, you want to have about a 670 plus, right? They're very friendly for people that are rebuilding their credit, and they're easier on approvals than, say, Amex. But they still want a clean recent history, even if you have a decent score, right? Next is the Apple Card, and they're going to typically pull from TransUnion. You want to have about, at minimal, a 670 credit score, but for stronger approvals, you want to have that 700 plus. In reality, they're not as easy as people think, and they weigh heavily on income, debt to income ratio, and utilization. But they're best for soft pulls from the pre-approval. But once you do go through with the offer and accept it, they will give you a hard pull. Continuing with these tier 1 pre-approval, soft pull, low risk entry lenders. Next, we got Upgrade. Typically, they're going to pull from TransUnion. What Upgrade and the Upgrade card actually is, it's a hybrid product. It's an installment style credit line, and it's not a true revolving card, right? It reports more like a loan than a credit card. Approval ranges on the minimum side is about a 600 to a 620, but for common approvals, you want to have that 620 to 680 profile, and of course, 680 plus for better limits and lower APRs. When it comes to underwriting, they're going to focus on income consistency, your debt to income ratio, recent delinquencies, and sometimes banking activity, right? In reality, they're easier than Amex or Discover, but they have higher APRs and lower limits versus the prime cards, right? It's not ideal for utilization because it doesn't behave like a traditional revolving line, right? So this is really a bridge product. It's not a long-term funding tool. So we don't want to use it for that purpose. Next, we got the pedal cards, right? They're going to pull typically from Experian and TransUnion. And what it actually is it uses a cash flow underwriting system that analyzes your bank account activity, right? It's designed for people that have a thin to no credit file. Approval ranges at minimum is about a 580 to a 620. Common approvals happen around about that 600, 660 range. They can approve you, though, with no score in a thin file, and they offer 2 cards, the Pedal 1 no annual fee Visa card and the Pedal 2 cashback Visa card. When it comes to their underwriting standards, they focus heavily on bank account data, so income plus spending patterns, cash flow stability, but they have a low reliance on the traditional FICO model. So they're easier for approvals than Upgrade in some cases, but their limits are typically between 500 to 3,000 starting. So it's not a strong signal to major lenders. And this also is an entry level kind of credit builder account. It's not for scaling, but you want to start here to kind of gauge your approval strength and not really stack aggressively just yet. Now, moving on to tier two. These are your core bank approvals and primary funding lenders. So here we want to secure higher limit revolving accounts and we want to build real lender relationships. So the first lender we have is Chase. Chase is typically going to pull from Experian. Their minimum score threshold is about a 680. For more consistent approvals, you want to have that 720 to 760 credit score. When it comes to underwriting, Chase has their 524 rule. So you can't have more than 5 new accounts within a 24-month period or it's an auto denial. They do prefer 1+ year of credit history and they are sensitive to recent inquiries. Chase is very relationship driven and discipline driven. So if your profile isn't clean, I wouldn't apply. Next, we got Citi, right? Citi, they're typically going to pull from Experian or Equifax. At minimal, your score needs to be about a 680. But for consistent approvals, you want to have that 700, 720 plus credit score, right? Underwriting, they're very sensitive to recent inquiries and high utilization. They prefer a clean, low risk profile. They're not inquiry friendly for stacking, though. And Citi is quietly very strict, right? It looks easier on paper, but they deny often in practice. Next, we got Wells Fargo. Wells Fargo is typically going to pull from Experian. Their minimum score threshold is around a 660, 680. And for consistent approvals, though, you want to have about a 680, 720. When it comes to underwriting, they're moderately flexible versus Chase and Citi, but they still require a decent history and control utilization. And with Wells Fargo, they're basically a mid-tier prime lender, and they're easier for entry than, say, Chase, but not as easy as people typically expect. So continuing with these tier two core bank approvals, next we got Bank of America, right? They're typically going to pull from Experian or TransUnion. At minimum, their scores threshold is around about a 670. For more consistent approvals, you want to have around a 700 plus credit score. They're very relationship heavy, so having that checking savings accounts matters. And then internal risk scoring plays a major role with them. It's easier to get approved if you're a client and you have an existing banking relationship. US Bank, right? They're typically going to pull from TransUnion or Equifax. At minimal, their score threshold is around a 680. But for consistent approvals, you want to have about a 720, 740, especially for premium credit cards with them. Underwriting with them is very strict. They're extremely sensitive to new accounts and recent inquiries, and they prefer long credit histories and low velocity profiles. They're one of the hardest approval banks in this group. So the strategy is to apply after optimization. You want to space out your inquiries properly, and you don't want to hit all of them at once without properly sequencing. Tier three, let's get into these credit unions. These are the high approval probability credit unions. First, we got Navy Fed, right? Typically, they're going to pull TransUnion. At minimal, you're going to need about a 650. For consistent approvals, a 680, 720 plus. When it comes to underwriting, they're very relationship driven. They use an internal score plus banking activity. And that has to deal with more like your direct deposits, checkings, and savings balances and stuff like that. They're known for higher starting limits if your profile is clean, though. And they're one of the best lenders for funding, but only if you look low risk internally, not just on paper. Next, we have PenFed, right? And typically, PenFed is going to pull Equifax. Their minimum score thresholds are anywhere between a 650 to a 660. But for consistent approvals, you're going to need about a 680, 700 plus credit score, right? When it comes to underwriting with them, they're more score driven than Navy Federal, but they still do consider things like your debt to income ratio and income stability, right? They do give more moderate limits versus Navy Federal, though. And they're a good mid-tier credit union, right? They're easier for entry than, say, most big banks, but they're not laxed. Right. Next on the list, we got Alliant Credit Union. And with Alliant, they're going to pull from Experian or TransUnion. Right. Now, when it comes to the minimum score thresholds with them, it's going to be about a 660, 680. But for more consistent approvals, of course, you want to have about that 700 plus credit score. Now, when it comes to underwriting, they require a clean, stable profile. Right. And they're less forgiving than people typically expect. They prefer low utilization and an established credit history. And they're closer to a prime bank when it comes to their standards than typical credit unions. Next, we got Digital Federal Credit TransUnion or DCU. Typically, they're going to pull from Equifax. And when it comes to their minimum credit scores, you're going to need about a 640 to 660. But for more consistent approvals, you want to have about a 660 or 680 to 700 plus. Now, with underwriting, they're more flexible than Alliant, and they're good for rebuilding and transitioning to prime. They do have lower starting limits typically, and it's a solid bridge lender before moving into higher limit institutions, right? So here we just want to build the relationship first with that checking account, savings account, and it's strong for personal loans and high limit credit cards. Tier 4, we got fintech or alternative lenders, right? This is your support layer. Here we want to fill gaps and build additional limits, right? These are for secondary approvals. So SoFi, for example, they're going to pull from Experian. When it comes to their minimum score threshold, it's around about a 650. For more consistent approvals, you want to have that 680 to 720 plus. For underwriting, they're more income driven. They're looking at your debt to income ratio, employment stability, and existing relationships with the SoFi ecosystem. In reality, they look prime, but their approval model is a cash flow driven approval model, right? With them, limits are very moderate unless income supports higher exposure. And they're the closest thing to a legit mid-tier card in this group, but still not a top funding lender, right? Next on the list, we got Avant, right? Avant is going to pull from Experian typically. Their minimum score threshold is around a 580, 600. But for more common approvals, you want to have that 600, 650. When it comes to underwriting, they have more of a subprime tolerance for prior delinquencies and things like that. They're more forgiving, and they're looking at things like income plus your ability to repay. They do have higher APRs, lower starting limits around 300 to 1,000 typically, and fees may apply. We only want to use them to rebuild. They're not useful for optimization or funding positioning. And then the last one we have on the list is Lending Club here, right? Typically, they're going to pull from TransUnion. At minimal, you'll need about a 600 to 620 credit score. But for more consistent approvals, you're going to need that 640, 680 plus. Their primary products, though, are personal loans. So their credit card offerings are limited and variable. They're primarily a loan platform. When it comes to underwriting, they also are looking at things like debt to income ratio, income plus your cash flow, and existing debt load. Again, they're more loan focused than card focused, and approvals also often come with lower limits and higher rates. It's more better for debt consolidation or a personal loan play. It's not really good for a funding stack tool, and you really want to use after your core approvals and not your primary stack. Now let's talk about bureau control strategy, right? Managing your inquiry distribution across the bureaus. So the principle here is that you're not applying randomly. You're allocating inquiries across bureaus to preserve a low risk profile and maximize approval. What you want to target is 1 to 2 inquiries per bureau. What you want to do is you want to sequence applications based on known bureau pools. You also want to space those applications within a controlled window, typically 24 to 72 hours for stacking. You want to monitor each bureau before applying, so you want to pre-check your reports, and then you want to avoid exceeding 2 inquiries per bureau in a short cycle. So the bottom line here is you're not just building credit, you're actually engineering how lenders see risk across all 3 credit bureaus, if that makes sense. Now, bureau freezing strategy. The core principle here with this strategy is that you want to selectively freeze 1 to 2 credit bureaus so that you can constrain which report a lender can actually access. Effectively, you're just going to be steering them in the hard pull to a bureau you actually want, right? So how you use this is you're going to either freeze Experian, TransUnion, or Equifax at the consumer level. You're going to apply with the lenders that have the predictable pull behavior, and that lender is forced to use the only available unfrozen bureau, which is your strongest bureau. So strategically, you want to concentrate the pulls on your cleanest bureau, right? Your cleanest report. Some risk and failure points with this is that some lenders will refuse the process with frozen files. Some of them will attempt secondary bureau pools or multi-bureau verification, which can trigger things like manual review flags, identity verification delays, and misuse will equal denials plus wasted time. So again, you only want to freeze after pre-checking all 3 credit reports. You want to use with known single bureau pull lenders, and you want to unfreeze immediately if applications stall, verification is requested. And you never want to combine this strategy with high inquiry velocity or an unstable profile data, right? So the bottom line is that you got to understand this strategy isn't a beginner tactic, right? It's a precision tool for controlling lender visibility, right? Effectively, only when your bureau data, timing, and lender selection are already dialed in. So now let's go over the ideal application flow, right? The objective here is to sequence your applications to maximize your approvals, right? You want to protect your profile integrity also, and build limit capacity, not just accumulate accounts. So step one is pre-approvals, right? Those tier ones. And the purpose is to validate your eligibility with minimal risk, right? We want to use soft pull pre-qualification tools. We want to target issuers with predictable approvals and establish initial approvals without adding inquiry pressure. Second step is those core banks, the tier two lenders, right? The purpose is to secure higher value primary trade lines, right? And we want to apply to the major banks. We're going to prioritize things like the lowest current inquiries, cleanest bureau data, and we want to execute within a tight window, right? Same day or 24 to 72 hours. Step three is credit unions or the tier three lenders. Purpose here is to expand limits with the relationship based lenders, right? So we want to target credit unions with higher approval tolerance, strong limit potential, and we want to leverage existing relationships and cleaner bureau positioning for easier steps, right? And then step four is to fill those gaps with those tier four lenders, right? The purpose is to optimize the profile structure and not just chase approval. So we want to add accounts only if needed for things like account mix, on the revolving side or the installment side, utilization paddling, where we want to help pay down some utilization, thin file correction, where we want to build out the profile, and we want to avoid unnecessary fintech or subprime accounts, right? So the bottom line is that this flow is not about volume. It's about a control sequence, right? So we want to validate, anchor, expand, and then optimize. And when you do it correctly, you're going to increase your approval probability, your starting limits, your long-term funding capacity. And if you do it incorrectly, you're going to trigger things like denials, inquiry overloads, and internal risk flags. So some next steps, you got two options from here, right? Option one is my free workshop. Inside the workshop, you'll learn my full credit optimization and funding breakdown, what lenders and underwriters actually are looking for, and common mistakes that cause denials, and a step-by-step framework to position your profile correctly, right? So if you're still in the learning and understanding phase, you want to start here. Option two is a strategy call, right? This is best for people who are ready to execute with some precision, right? On this call, we'll run a full personal credit audit. We'll identify what's helping you, what's hurting approvals. We'll build a custom optimization plan, map your funding readiness strategy, and outline some exact next steps based on your actual profile, right? And this is where you move from information to execution, right? So this is not for people who are just curious, not ready to take action, unwilling to fix their profile. This is for people who really want to increase approvals, access higher limits, and position themselves for real funding, right? So the links are below in the description. Either register for the free workshop or book your strategy call today. Choose one and let's move forward.